Hello everyone, welcome to Qianmo Accountants. In this video, I will talk about business valuation. Business valuation is to value the worth of a business in dollar value. If someone intends to buy the business, they expect to pay an amount in the ballpark of this value. Business valuation is one area of knowledge that is essential for many finance and accounting roles. It is required when your clients or your company wants to sell the business, going through a merger and acquisition process, determine the shareholders' ownership percentage, looking for finance, or sometimes even going through divorce. Unlike property valuation, valuing a business can be challenging, as you might imagine, because each business is unique in its own way. There are many ways to determine the value of a business, as long as it is a value that both the seller and the purchaser accept. For example, for small and simple businesses, people probably look at the net assets of the business on the current balance sheet, which is all the assets, deduct all the liabilities, and then they find an acceptable value based on that net asset. Or we look at how much it would cost us if we start a similar business. Like we count into the amount required for buying the assets and the operating costs for 1 year's trading to determine how much we are willing to pay for this business we're assessing. This is referred to as the entry cost method. For larger businesses, one of the common methods is discounted cash flow, which is DCF. Don't be deterred by its fancy name. It is in fact based on a very simple logic. We estimate the future year's annual cash flows based on the past few years' financial performances. Then we determine a discount rate because money tomorrow is not as expensive as money today, right? If it is the same amount of money we're going to get, who wouldn't want it today? Why wait for the future, right? So with that logic, the money we get for the future, it is discounted to a less sum as of today. We use this formula to discount the future cash flows back into the present. And that way, we get a value at present. This is one model of valuation, the DCF. There are also many other methods. You can just easily Google the formulas and steps, and you will find that all those methods are quite simple and straightforward with the numbers and the formula. But in fact, what is tricky about business valuation is that it is not a number simply determined by a formula, no matter what method we choose to use. The difficulty lies in understanding on what basis does this valuation make sense. Because after all the parties involved in the deal needs to accept the valuation eventually. To illustrate this, let's compare two businesses, Netflix and the Meijer stores. I choose those two businesses because they are different in many ways, allowing us to compare the factors that determine their valuation differences. Meijer is an Australian mid-range to upscale department store chain. It operates 56 department stores across Australia, as well as operating an online business store. Every state in Australia has Meijer stores. It also has a long history. The first Meijer store was opened in the year of 1900. Netflix. Well, we all know Netflix. Netflix was founded in 1997. It is an American subscription-based OTT, over-the-top streaming service, meaning over the top, bypass the cable, the broadcast, and satellite televisions. Looking at the income statement, revenue in Meijer comes from the sales of goods, which is 2,565 million Australian dollars. The largest cost is the cost of goods sold, which is about 60% of the revenue. Revenue in Netflix comes from its subscription, which is $33 billion. The cost of revenue is $19 billion, which is 57% of the revenue. The majority of Netflix cost of revenue is the amortization of the streaming content assets. Looking at the balance sheet, the largest asset in Maya is the right-of-use assets, which is the retail store leases. This accounts for 45% of the total assets. The largest asset in Netflix is the content assets, $31 billion, which is 65% of the total assets in Netflix. Both businesses are listed and have been quite successful. Now let's look at the valuation. The current market values as of May 2024 are 552 million Australian dollars for Maya and $273 billion for Netflix, based on their respective market capitalizations. Maya's market cap is about 22% of its revenue for the financial year 2023, while Netflix's market cap is about 8 times its annual revenue. We also look at the market capitalization to the net asset for each business. Net asset is the total asset less the total liabilities. Maya has a net asset of 240 million Australian dollars, and Netflix is $20 billion. Maya's market cap is about 2.3 times of its net asset, and Netflix's market capitalization is 13.65 times of its net assets as of the end of financial year 2023. So both are successful business. Maya even has such a strong brand recognition that it has operated for over 100 years. But why is Netflix valued so much higher than the traditional department store? Actually, the underlying reasoning that determines a business' present value is not so complicated if we think about it. We would buy a business because we expect it to bring us future profit or cash flow, right? Essentially, it is people's expectations of how much profit or cash flow the business can generate going forward. The variance that we see in the market valuations between Maya and Netflix is due to the differences in their business models, which determined how much cash flow people generally expect the business to generate and how easy or hard it is to generate that cash flow. Businesses with higher valuations have certain characteristics: recurring revenue, a large market, high growth, high profit margins, high barrier to entry, and low labor cost. Because all those characters are more likely to point to one result: generating more profit or cash flow in the future and easily generate them. On the other hand, businesses with lower valuations have just the opposite characteristics. This does not mean that the businesses having lower valuations are not successful businesses though. They just have lower valuations because buyers expect they will generate fewer future cash flows relatively, or will require significant effort to generate future cash flows. Does Netflix have those characteristics then? A quite winning characteristic with Netflix is the subscription business model. Believe it or not, Netflix started by renting DVDs, but they very smartly introduced a monthly subscription model in the year of 1999. The monthly subscription model made the business income recurring rather than transactional. You don't need to always look for new sales. You get one customer, and likely this customer will be paying you on a recurring basis for quite a long time. Even though it may be a small subscription fee, but your focus can be moved on to getting more customers and the market growth, rather than constantly putting in effort for the next sale. So as you can see, nowadays, the subscription model is so popular. Netflix, Apple TV, YouTube channel subscriptions, gym subscriptions, online learning subscriptions, everything can be on subscription basis. Even accounting firms and consulting firms nowadays are gradually starting to set clients on automatic monthly or quarterly installments of payments, compared to in the past, invoicing clients after the work is done. So by comparison, the biggest difference between Maya and Netflix in terms of their business models are: first, recurring revenue model. Netflix puts people on subscription, but Maya must put in efforts to make each sale. And second, profit margin. Netflix does not have a significant cost of sales, so one more subscriber means more revenue just to come through. In contrast, each item purchased at Maya stores has an associated cost of sales with it, resulting in a smaller profit margin. And third, labor cost. People generally subscribe to Netflix on their own, whereas selling goods at Maya requires hiring labor, right? So all of those differences sent the signals to people in the market. You could expect relatively bigger and easier cash flows in the future in the business of Netflix than the Maya stores. So this explains why Netflix is valued higher. But does it mean that Maya is not a successful business? Of course not. Each industry is different and has its own models. Sometimes it's just hard to break out of the industry's inherent model. Maya has been a quite successful business in the retail industry. After all, we do not only want to watch movies, we also need to purchase so many other things, right? Okay, that's what I'd like to share about business valuation. I am an accountant and has worked in accounting firms for over 12 years. I provide technical training to junior accountants to improve work performance and start a successful career in accounting firms and the accounting industry. Accounting could be way beyond just number crunching. We could be the best business advisors without knowledge about accounting and many aspects in business. Okay, that's all for today. Hope you enjoyed this video. See you next time. Bye!